many African investors already have a comprehensive understanding of companies operating on the continent. Aside from the large South African multinationals, there are a host of dominant locally listed companies that can be expected to generate excellent returns for investors. Now, investing in these companies is the iPro Africa Market Leaders Fund, jointly run by Amit Bakita. I think I gave you very different names today in terms of trying to introduce you into the program, but I'm hoping that we'll certainly get it right now. Amit, thank you for coming to our studios from Botswana, we must mention, and finding the time to talk to us. Let's just talk about trying to find those African companies that are outperforming. Just how difficult is it when you try and step outside of South Africa and you say, let me find very good locally listed companies in Africa?
Yes, I think that, finding these companies are not that difficult actually. It is quite easy because of the fundamental growth that these underlying economies are experiencing or are expected to experience in the coming years. When you look at key markets, for example, we've got countries like Nigeria, we've got countries like Kenya, or even Rwanda today that are harboring extremely prospectful companies. And so, the question about finding these companies, no, it's not really a problem. But there arises certain, obviously, market problems, liquidity constraints, investing in these companies, and obviously different economic problems.
So when you look at Africa, do you get excited when you look at the opportunity? Everybody's speaking about how these are really exciting times for African countries. I mean, we're talking about 7 of the 10 fastest growing economies in the world being in Africa.
We at the group level, we're extremely excited by the opportunities in Africa, and originating from the small island of Mauritius, which is kind of maturing right now, we see enormous prospects and enormous opportunities in Africa. Most of the big conglomerates in our country, they are moving towards, sub-Saharan African countries today. Now, when it comes to Africa, I think we are well poised to benefit from on numerous grounds actually, because the continent itself, it is growing, and we tend to focus on 3 core sectors, which is one, obviously the banking. All the economic development of any economy should go through the banking and microfinance sector. Secondly, through the consumer sector, because we're extremely favorable and we believe in the rise of the African consumer. And thirdly, obviously, we are looking at the infrastructural sector, because Africa needs to engage in this development path, and obviously it's going to come through infrastructural reforms.
Amit, just to ask you about these thematic trends that you've identified. Obviously, one of them is the banking sector. In terms of some of the banks, I see you've got a couple of the Kenyan banks and some of the Nigerian banks.
Exactly.
What is the fundamental driver behind the earnings of those companies? Because we understand that there are problems around doing secured lending in different parts of the continent. So when you look at these banks, what's really driving that earnings growth for banks like Equity Bank in Kenya?
Equity Bank in Kenya, has fundamentally always been driven by a good balance of retail credit growth and corporate credit growth as well. Plus, it is founded on what we call the agency banking model, which is extremely positive for the bank itself. Now, coming back to the real earnings driver, I think we need to be able to differentiate between the banks in Africa today. Now, banks in Nigeria and Kenya, for example, their underlying fundamentals are completely different from banks in Ghana, for example, today. But when you look at these banks, one of the most fundamental earnings driver is obviously their pricing. Compared to South African banks, compared to the broader emerging market or the developed banks in the world today, their spreads are quite healthy in these countries. When you look at Nigeria and Kenya, for example, the pricing spread is relatively healthy. Now, if you move further towards the unsecured lending or the microfinance segment of these financials, the margins get even fatter on that side. But again, this is I think, over the long time, it's going to change as the market gets more competitive, etc., etc. And I think this is the same thing that's happening in South Africa today, where we see the margins getting compressed, and obviously the banks to be able to increase their earnings going towards much more unsecured lendings.
Just in terms of that, I think it's, you know, we still have a massive amount of the population, a couple million people that are still unbanked. When you talk about rolling out primary banking products to these people in the form of a deposit-taking institution where they can go and deposit cash at a branch, how much of the population in Kenya and places like Nigeria are banked at this point?
We estimate the unbanked population to be roughly in the region of 35 to 40%. In Botswana, for example, it is estimated to be around 50%. But what we need to bear in mind is that retail banking accounts for most of these statistics, but the unbanked population right now is being serviced by what we call as informal microfinance institutions, loan sharks, etc. So again, there's tremendous output gap, there's tremendous opportunities that we are looking with respect to that unbanked segment.
Yeah. Now, of course, investing in Africa is a challenge. We know there are many issues that you would not find in your more developed markets like Mauritius, like Johannesburg. In terms of exiting this market liquidity, regulation and all those kind of things, just how difficult is it when you get into geographies like Nigeria, your Rwanda, probably your Tanzanias, your Zimbabwe's, etc.?
Exactly. In terms of liquidity, certain markets are relatively liquid. When we look at the Egyptian market, for example, today, the Kenyan market, or for that sake, the Nigerian market, they are extremely, extremely liquid. When I say liquid, it's obviously relative. I mean, depending on certain stress based on the different economic cycles, etc. But compared to South Africa, these markets are liquid today. For any fund, an equity fund ranging, you know, in the region of 100 to 250 million US dollars today, you know, these markets are relatively liquid. But if we tend to grow higher, for example, a $1 billion, $1.5, $2 billion equity fund in Africa today, this would be extremely, extremely problematic.
Let's come to your fund and talk about what you have been doing there and the investment strategy that you have been following. Give us a sense of what has driven first the investment strategy, and then let's get perhaps into the performance.
Okay. With respect to the investment strategy, we are very, very focused. We tend to follow a blend of what we call as value investing and obviously technical investing as well, because again today the way fund management business is moving, there needs to be a very solid grasp of the economic fundamentals, one, and secondly there also needs to be a very important understanding of the technical side of equity investing. Now, with respect to the fund strategy, we invest in the most liquid funds, that is the market leaders. What does that mean? It means companies who are actually market leaders in their respective segments or future leaders of tomorrow. So we've been investing in the most liquid companies, and we find the performance relatively better compared to the other African equity peers today. Why? Because we have been very conservative in our approach. Now, just to make things simple, African investments today are benchmarked by certain MSCI and S&P Africa indices, which are completely irrelevant to what we call risk-adjusted investments. What does that mean is that most of these indices today have got more than 40%, 50%, or even 60% allocation, geographic exposure to either Nigeria, South Africa, Egypt or Kenya. So this is problematic for any investor because you don't want so much exposure. When it comes to individual holdings, some of these indices even have up to 18% to a single stock. So we have tended to diversify from this conservative, straight line approach. So we are very, very well diversified. We don't stick to those concentrated benchmarks. And since 2008, when we incepted the fund, the fund has returned about 40% in US dollars term. This year, the fund is already year to date positive by about 15%, which is extremely, extremely interesting when we compared global equity or global emerging markets performance this year.
Don't go there.
I think just to ask you about some of the interesting picks that you've made recently, you've indicated you've taken positions in Zambia Sugar and Mumia Sugar.
Exactly.
What was the rationale behind those investments?
Yes, I mean, these investments are very, very simple because today we need to understand that most of these sub-Saharan African countries are facing an amazing, what we call as a supply gap with respect to their cement production, with respect to sugar production and obviously with respect to their alcoholic beverages production. So Mumia Sugar and Zambian Sugar are simple examples of companies that today are quite cyclical because of the cyclicality of the business, but which are extremely undervalued. What we need to understand is that fund management today, even in Africa, is moving towards much more of a dynamic approach. When companies are overbought, for example, Nigerian equities today, after the massive 30% rally, we need to be able to reduce our allocations. And over the long term, when it comes to Mumia Sugar and Zambian Sugar, we're extremely positive on the soft commodities outlook. And we want to own companies with what we call as hard assets.